Hi there, welcome back to my channel. In this video, I'm going to walk you through my course which I have posted on Fourth Wall, which you can access, of course, on my channel shop. So in this particular video, I'm going to walk you through what we did actually. So the peculiar thing about this particular course is that I demonstrated how to build a financial model without any historical financial data. So as you can see, this is a complete financial model. It has the assumptions tab. It has the three main financial statements, including the income statement, the balance sheet, and the cash flow statement. We supported our calculations with supporting schedules. We backed that using valuation tab, where we valued this particular business using the DCF valuation model. And I also promised to add charts and graph, which I will be posting for free on my channel. So be on the lookout for this particular video. All right, so what I'm going to do basically is to walk you through what we did in that particular course so that in case you want to learn this particular valuable skill, you can be able to make that decision. All right, so let's open. So this has been grouped. I've demonstrated that in the course. So when you come here and you click the number 2 here, it's going to collapse all of the group tabs of your model, and then when I click on 1, it's going to group them back. All right, so I'll click on 2, and that's going to open all of my tabs. Now this company is called the Genza Inc. All right, as you can see from the top right here. So that is the tab, and then we are saying that this particular company is a new company. All right, so it doesn't have any historical financial data, and it's going to start in the year 2026. All right, and the prospective owners of the company are interested in knowing the performance of the business in the first 5 years. All right, so that is starting from the year 2026, which is a startup year, to 2030, which is the terminal year for the purpose of preparing this particular financial model. All right, so that is what we are having here. And this particular company is an e-commerce company. It's going to be trading online, but it's going to have some offices across Africa, across Europe, across America, South America, North America, and Asia. All right, so these are some of the intricacies or some of the brief information or background information about Genza Inc. All right, so that is what they'll be having. And so in this particular type of model, majority of our efforts is going to be based on making relevant assumptions. And when making such relevant assumptions, it's good to understand the business model. All right. 2, the aim of management. What is management trying to achieve over the period of the model? And then 3, you need to understand the macroeconomic environment in which the business is trying to operate in. All right. So that is what will inform some of the assumptions you're going to make in this particular kind of situation. All right. So as you can see, we have assumptions for income statement. That is basically going to help us to understand our revenue over the period, the cost we are going to incur, as well as how much profits we are going to make in the first year through out the financial modeling period. All right, so that is what we have here. Now, since this business is an online business, we are expecting that the business is going to be making um, much of its revenues through the following: organic searches. So people are going to search for the business through organic search, that is maybe Google search or any other search on the internet. All right, and then we're going to be having some social media paid marketing advertisements, something like that. We're going to be getting what visitors on the site of this particular business from email marketing, as well as through affiliate marketing. All right, so that is what we are expecting from our visitors on the company's website. Okay, and then we calculated the total monthly visits, and then we converted these monthly visits into annual site traffics. So these annual or monthly visits are converted into annual using this particular annual visits through each channel multiplied by 12 months. All right, so that is what we have here. Then we come to the conversion rate. So out of the number of people who are visiting our sites annually, how many of these site visits are actually going to convert into actual clicks on our products or our services. All right, so that is the conversion rates, the assumptions that we have made here. All right, and then we have the total annual visits, which is actually our total orders placed. All right, total orders placed here divided by our total annual visits. All right, so that is what we are having there. Then we also have assumptions for order details. So gross price per product ordered, number of products per order, application markdown per order, application discounts per order, as well as our gross margin on each order. All right, then we calculated our gross order price as well as our net order price using these order details information here. Then we obtain some information on our customers, okay, our potential customers, of course. So we have our customer information, such as customer churn rates. All right, that talks about how the rate at which our customers are going to be churning, or they're going to be stopping from purchasing from us, the rate at which they will stop purchasing from us. That is the churn rate. All right. Then we have our beginning customer base, which is obviously zero. Then we have new customers, which we have calculated from here. So as you can see, the new customers are the orders you have gotten from organic search, social media, and affiliate marketing. All right. Email marketing is zero. I explained that in my video. So that is our new customer base. Then we have our total customer base at the start of the period. We less our churned customers, which is the multiplication of the churn rate by the total customer base at the start of the period. To get that, then we subtract the churned customers from the total customer base to obtain our customer base at the end of the period. All right, so the end of the period customers become the beginning period customers, and then we add a new, and then it follows a that corkscrew movement. All right, so that is that. So all of these are going to help us in building our income statement up to EBITDA. All right, so that is that. Then we have some expenditure um, assumptions here. Marketing expenses, which is a variable cost. We have order fulfillment, which is also a variable cost. Then we have storage or warehousing cost, which is a semi-variable cost, something like that. Then then we have general and administrative expenses, which are usually fixed. All right, then these comprise wages and salaries, office rent, and other general and admin expenses like that. Then we have our corporate tax rate, which is 25%. All right. Then you have the balance sheet. Now, this corporate tax rate is usually the US tax rate, okay, 25%, which is usual. Then we have the balance sheet assumptions here. You have the inventory days, accounts receivable days, accounts payable days. We made assumption for short-term non-interest bearing debts. All right. We have assumptions for our capital expenditures, useful life for depreciation purposes. Then we have the capital structure assumption, which we are saying that the business is going to be wholly financed through equity capital. All right, so that is what we have there. All right, now after the assumptions were made, we went ahead to build our income statement. All right, so that was the income statement. We built in a cost from gross earnings. We deducted our discounts and markdowns on our products sales. We calculated our cost of sales or cost of goods sold, calculated our gross margin, came to variable cost, subtracted that to get our contribution. Now, when you look at the contribution, you could see that we have negative contribution initially, and then this improved into positive, okay, contribution over the period. All right, and this is a new business, so it is usual for a new business to incur losses initially before progressing into making profits. All right, so that is usual. Then we calculated our contribution margin, as you can see there. Then we have our fixed operating expenses, which comprises two items, as you can see. Then with that, we are able to calculate our operating profit or earnings before interest, taxes, depreciation, and amortization, or EBITDA for short. All right, then we have our EBITDA margin. We calculated our depreciation from the depreciation schedule in the supporting schedules. Then we have our finance costs, income taxes to obtain our net earnings. Then we have dividends assumption in the assumptions as we have already looked at. All right, so that was the income statement. Then we come to the balance sheet. We have the non-current assets, which are technology and content, property and equipment. Then we have current assets, which comprise inventory, accounts receivable, and accounts payable as well. So the interesting thing about the course is that we didn't build any of these using previous figures. All right, we build them from no figures, basically. All right, so that makes it unique. All right, so you may want to find out how we're able to develop this, and this is an incredible skills. Okay, usually financial models are built using historical data, but that only applies to companies that are already in operation, that are already established. All right, so they have the historical financial data. However, where the company is new or it wants to venture into a new business, then you need to build these kind of financial models, and that is most often what we see practically. All right, so you may want to know this particular incredible skill. Right, so we went ahead to build our cash flow statement as well. As usual, this is the indirect method. So we have our net earnings. We added back non cash items, which we have depreciation in this particular case. All right, so that's what we have there. Then we have our changes in non-working capital, which we calculated um, from here, as you can see. Then we have our net cash generated from operations. We have our net cash used in investing activities as well, which are from capital expenditures. Then we also have our financing activities. We have issuance of equity, issuance or repayment of debt, which is zero throughout. Then we have payment for dividends. All right, so that is giving us our net cash from financing activities. Then we have our opening cash balance. We added our net increase or decrease in cash balance, which our net increase or decrease in cash and cash equivalents, which are the addition of the three major cash flow items. Okay, so that is that. Then we went ahead to build our supporting schedule, which comprised the PPE schedule, as you can see here. So it's a very nice one. We want to know how we calculated all of this using some unique formulas, as you can see in the formula tab here. All right, so you may want to find out. Let me undo that. You may want to find out how we're able to derive these using what cell referencing. All right, so you may want to know that. Then we also went ahead to build our debt schedule, which was virtually empty. But I went ahead to build this because you might be interested to know how the PP's schedule is built. And I also throw in a challenge where I admonished those who are taking the course to, make some assumptions for their debts and then go ahead and build this particular debt schedule as I have demonstrated. All right. Then we went ahead to value the business because the company was interested in knowing the value of the business at the end of the fifth year, which is 2030. And that's why I put the terminal value here or terminal year here. All right. So as you can see, this can be better valued using the DCF model. Okay, it is by far one of the most common valuation models in practice. All right, so we have our free cash flows or unlevered free cash flows to the firm. As you have calculated here, this is how we calculate it. All right, I demonstrated that. Then we valued our business to obtain the enterprise value. All right, and I also said that we could have calculated our equity value. However, because we don't have much information on debt, we decided not to tackle that. But you can do it on your own if you want to. So that is where we ended it. Maybe I'll try and value or calculate our equity value as well in addition to the total enterprise value when I am making the video on our charts and graphs, all right, to summarize some of the key outputs of our model. So this is how, or this is what we are able to do in that particular course. You may want to find out how we calculated all of these figures and made all of those assumptions. So try the course. I'll leave a link to download the course in my video description, or you can visit my channel pages and access the course via my fourth wall. All right, so thank you very much for your time. I'll see you in my next video where I'll add the charts and graphs to my model. All right, so again, this is the Gen Z analyst. If you have not subscribed to the channel, make sure you have subscribed to the channel and don't forget to like the video and share with others so they can also have access to these particular amazing videos. All right, so I'll see you in my subsequent videos.